Here's a fact that will infuriate financial advisors everywhere. A blindfolded monkey throwing darts at the stock pages can select a portfolio that performs just as well as one carefully selected by experts. Sounds ridiculous, right? It's been tested multiple times, and the monkey wins more often than you'd think. This is the provocative claim that launched Burton Malkiel's A Random Walk Down Wall Street, a book that sold over 1.5 million copies by destroying the myths Wall Street desperately wants you to believe. Malkiel, a Princeton economist, makes an explosive argument. Stock prices follow a random walk, meaning tomorrow's price changes are independent of today's movements and essentially unpredictable. If that's true, and 50 years of data suggest it is, then all the technical analysis, hot stock tips, expensive fund managers, and market timing strategies are worthless. You'd be better off buying low-cost index funds and ignoring the noise. Wall Street hates this message. The entire financial industry is built on the premise that experts can beat the market, that analysis reveals opportunities, and that their services are worth substantial fees. Malkiel proves that premise is mostly false. Study after study shows that active fund managers underperform simple index funds over long periods, especially after fees. The expensive advice you're paying for often makes you poorer, not richer. This book, continuously updated since 1973, has survived every market boom, crash, and bubble, while its core message remains unchanged. For most investors, the time-tested strategy for successful investing is brain-dead simple. Buy a diversified portfolio of low-cost index funds, hold forever, and ignore everyone claiming they can beat the market. That's it. No complexity, no excitement, just mathematics and discipline. Over the next 30 minutes, you're getting 8 powerful lessons from one of investing's most influential books. These lessons will either save you hundreds of thousands in fees and poor returns, or they'll make you angry because you'll realize how much money you've already wasted on useless advice. Either way, you need to hear this, ready to learn why almost everything Wall Street tells you is designed to enrich them, not you. Let's go. Chapter 1. The Random Walk Theory. Why stock prices are unpredictable. Malkiel's foundational argument is that stock prices follow a random walk, meaning future price movements are independent of past movements and cannot be reliably predicted. If a stock goes up today, that tells you nothing about whether it will go up or down tomorrow. Past price patterns don't predict future prices. This demolishes the foundation of technical analysis and most active investing strategies. The random walk theory emerges from the efficient market hypothesis, the idea that stock prices reflect all available information at any given moment. When new information emerges, earnings reports, economic data, news events, stock prices adjust almost instantly. By the time you hear the news, it's already priced in. You can't profit from public information because everyone else has the same information and has already acted on it. Malkiel explains why these matters. If markets are efficient and prices are random, then trying to predict future prices is futile. Technical analysts who study price charts looking for patterns are seeing mirages. Fundamental analysts who crunch financial statements are mostly analyzing information already reflected in current prices. Market timers who try to buy low and sell high are gambling, not investing. He provides compelling evidence. Multiple studies comparing professional investors to random selection show that professionals, on average, don't beat the market. Some beat it in any given year, but different ones each year, suggesting luck rather than skill. Over longer periods, the vast majority of professional fund managers underperform simple index funds, especially after accounting for their fees. The dart-throwing monkey example is real. Researchers have repeatedly compared expert stock picks to random selection, and random selection often wins. This isn't because experts are stupid. It's because in efficient markets with random price movements, nobody can consistently predict better than chance. Expertise doesn't help when the underlying phenomenon is random. Malkiel addresses the psychological resistance to this idea. We desperately want to believe markets are predictable, that patterns exist, that experts know something we don't. Accepting randomness feels like accepting that we have no control, that intelligence doesn't matter, that expensive advice is worthless. This psychological discomfort makes people reject evidence staring them in the face. He also acknowledges exceptions. Markets aren't perfectly efficient. They're reasonably efficient. There are rare opportunities for truly superior investors with unique information or insights. Warren Buffett isn't a myth. But these exceptional investors are extraordinarily rare, nearly impossible to identify in advance. And their strategies usually aren't accessible to regular investors. The practical implication is devastating to the financial industry. If prices are random, then most investing advice, trading strategies, and managed funds are selling false hope. The fees you pay for active management, often 1-2% annually, are buying you nothing but underperformance. Over decades, those fees compound into hundreds of thousands of dollars in lost wealth. Malkiel explains the mathematics. If active funds charge 1.5% annually and underperform the market by even 0.5% after fees, you're losing 2% annually compared to index funds charging 0.1%. Over 30 years, that 2% annual difference transforms $100,000 into $181,000 in the expensive active fund versus $328,000 in the cheap index fund. Same starting amount, $147,000 difference, purely from fees and underperformance. He also addresses why active funds sometimes beat the market. With thousands of funds, statistics guarantee some will outperform purely by chance. The same way some lottery players win. The industry highlights winners while ignoring that most funds underperform. They're showing you the lucky monkeys while hiding the unlucky ones. The hard truth, if you can't predict stock prices and professionals can't either, then the optimal strategy is buying the entire market through index funds, holding forever and minimizing fees. This approach guarantees you'll capture market returns, which historically average 8 to 10% annually, enough to build substantial wealth through compound growth. Anything else is gambling disguised as investing. Chapter 2. The Firm Foundation Theory versus Castle in the Air Theory. Malkiel introduces two competing theories about what determines stock prices. The Firm Foundation Theory says stocks have intrinsic value based on fundamental factors: earnings, dividends, assets, growth prospects. Investors who correctly calculate intrinsic value can identify overpriced and underpriced stocks, buying low and selling high. The Castle in the Air Theory says stocks are worth whatever someone else will pay for them, regardless of fundamentals. Prices are driven by psychology and crowd behavior. The game isn't calculating intrinsic value. It's predicting what other investors will believe and getting in before them. You're not buying value. You're buying ahead of the crowd. Malkiel examines both theories through history. The Firm Foundation approach seems rational. Analyze companies, determine true value, buy when price is below value. The problem is that intrinsic value is subjective and uncertain. Analysts using identical data reach wildly different value conclusions. If experts can't agree on intrinsic value, how can it guide investing? The castle in the air theory explains bubbles perfectly. During the Dutch tulip mania of the 1600s, single tulip bulbs sold for more than houses. The buyers knew tulips weren't fundamentally worth that much. They expected even greater fools to pay more. Everyone was building castles in the air, betting on others' belief, not on tulip value. He examines modern bubbles through this lens. The dot-com bubble of the late 1990s saw internet companies with no profits valued at billions. Investors knew many had no viable business models. They invested anyway, betting the stock would go higher before it crashed. Pure castle-in-the-air logic. Until it wasn't. The castles collapsed, destroying trillions in wealth. The 2008 housing bubble followed the same pattern. Housing prices divorced from fundamental values like rental income and household earnings. Everyone knew it was unsustainable. Most believed they'd sell before the crash. They were wrong. The castles collapsed again. Malkiel's insight is that both theories are partially right and wrong. Long-term fundamentals matter. Companies with strong earnings, growth, and cash flow create value that eventually reflects in stock prices. But short-term psychology dominates. Prices swing based on fear, greed, trends, and crowd behavior that have nothing to do with fundamentals. The practical lesson: trying to exploit either theory is dangerous. If you buy based on fundamental analysis, you might be right long-term, but face years of losses if psychology turns negative. If you buy based on psychology, you're gambling on timing, getting in and out before the crowd shifts. Most people fail at both. Malkiel argues that accepting the limitation of both theories leads to the same conclusion as random walk theory. Don't try to outsmart the market. Buy the whole market, own everything, and let long-term fundamentals work in your favor while ignoring short-term psychological swings. This approach benefits from firm foundations without requiring perfect analysis and survives castles-in-the-air crashes because you're diversified. The action step: stop trying to identify undervalued stocks through fundamental analysis. Stop trying to ride trends through technical analysis. Both approaches feel smart, but usually fail. Instead, buy broad market index funds that own thousands of companies. You'll own all the fundamentally solid companies without needing to identify them. You'll survive all the bubbles because you're diversified across everything. Chapter 3. Technical analysis is astrology for investors. Malkiel systematically destroys technical analysis, the practice of studying price charts and trading volume to predict future price movements. He calls it astrology for investors because it looks scientific but has no predictive power. Technical analysts identify patterns like head and shoulders, double bottoms, and moving average crossovers, claiming these predict future prices. The evidence says otherwise. The fundamental problem with technical analysis is that it contradicts the random walk theory. If past prices predict future prices, then markets aren't efficient. Information from price history isn't already reflected in current prices. But decades of testing show that technical patterns have no reliable predictive power. The patterns technical analysts see are random noise. Our pattern-seeking brains force into significance. Malkiel cites study after study showing technical trading rules don't beat buy-and-hold strategies. Researchers test every technical indicator moving averages, relative strength, chart patterns, volume signals, against simple strategies of buying and holding. After accounting for trading costs and taxes, technical strategies consistently underperform. The only consistent winners are brokers collecting trading commissions. He explains why technical analysis persists despite evidence it doesn't work. First, confirmation bias. Technical analysts remember when their signals worked and forget when they failed. Second, survivorship bias. We hear about successful technical traders, but not the vastly larger number who failed and quit. Third, luck masquerading as skill. In any large group, some will succeed by chance, convincing themselves and others that their techniques work. The psychological appeal of technical analysis is understanding. It provides illusion of control in chaotic markets. Charts and indicators feel scientific, creating false confidence. The language, support levels, resistance, breakouts, sounds authoritative. But sophisticated terminology doesn't make it valid. Astrologers use sophisticated terminology too. Malkiel also addresses the self-fulfilling prophecy argument. If enough traders follow the same technical signals, don't those signals create their predicted outcomes? Theoretically, yes. Practically, this effect is overwhelmed by fundamental investors, algorithmic traders, and the sheer size of modern markets. Technical signals are noise in oceans of other information and trading activity. He reserves particular scorn for Elliott wave theory, Fibonacci retracements, and other complex technical systems. Their practitioners claim they predicted past crashes and rallies. Malkiel points out that these predictions are always retrospective. After events occur, practitioners show how their system predicted them. But real-time predictions fail constantly. It's easy to find patterns explaining the past. It's impossible to find patterns predicting the future. The practical damage of technical analysis is that it encourages trading. Every signal triggers buying or selling. This generates commissions and taxes that destroy returns. A technical trader might make dozens of trades annually, each generating costs. An index investor makes essentially no trades, generating minimal costs. Over decades, the cost difference is massive. Malkiel shares the devastating statistic: the average technical trader underperforms the market by several percentage points annually after costs. Some beat the market in short periods through luck. Almost none beat it consistently over decades. Meanwhile, the simple strategy of buying index funds and never selling beats the vast majority of technical traders. The psychological challenge is that technical analysis feels active and smart. Studying charts, identifying patterns, executing trades, this feels like you're doing something. Buying index funds and holding feels passive and boring. But investing isn't entertainment. The boring approach wins. The exciting approach loses. The action step. If you currently use technical analysis, stop. Delete your charting software. Unsubscribe from trading newsletters. Close your active trading account. Calculate how much you've paid in commissions and taxes from technical trading. Then invest that money in low-cost index funds and commit to never selling based on chart patterns. The simplest strategy beats the most sophisticated technical analysis. Chapter 4. Fundamental analysis isn't much better. After destroying technical analysis, Malkiel turns to fundamental analysis, the practice of analyzing company financial statements, earnings, management quality, competitive advantages, and industry trends to identify undervalued stocks. This seems more rational than technical analysis. The problem? It doesn't work much better for most investors. The theory sounds solid. Study companies deeply. Calculate intrinsic value. Buy when price is below intrinsic value. If a stock trading at $50 is really worth $80, buying it provides a margin of safety and profit potential. The challenges are that intrinsic value is subjective, requires accurate predictions of uncertain futures, and the information you're analyzing is already reflected in current prices. Malkiel explains that fundamental analysis requires predicting future earnings, growth rates, interest rates, economic conditions, and competitive dynamics years in advance. These predictions are extraordinarily difficult. Even company management can't predict their own earnings accurately. Earnings surprises happen constantly. If the people running companies can't predict their earnings, how can outside analysts? He cites research showing that professional analysts' earnings predictions are barely better than simple extrapolation of recent trends. Analysts with decades of experience and unlimited research resources predict earnings for next quarter with huge error margins. Predictions for next year are even worse. Multi-year predictions are essentially random guesses dressed in spreadsheet sophistication. The efficient market problem undermines fundamental analysis. By the time you've analyzed a company's financials, thousands of professional analysts have already done the same thing. Any insights from publicly available information are already reflected in the stock price. You're not competing against average investors. You're competing against teams of PhDs with Bloomberg terminals who analyze companies full-time. Malkiel addresses the Warren Buffett objection, but Buffett uses fundamental analysis and became one of the richest people in the world. True, but Buffett is one person among millions of investors. His success doesn't prove fundamental analysis works on average. It proves exceptional investors exist, and Buffett himself recommends index funds for most investors, acknowledging that his approach isn't replicable by typical individuals. The practical problems with fundamental analysis for regular investors are time and expertise. Properly analyzing one company requires hours of studying financial statements, understanding the industry, evaluating management, and monitoring ongoing developments. To build a diversified portfolio requires analyzing dozens of companies. This full-time job competes with your actual job that pays your bills. Even if you dedicate the time, you're competing against professionals with superior resources, access to management, industry expertise, and experience. The odds of consistently beating them are slim. Occasionally, you'll pick a winner, but you'll also pick losers. On average, your fundamental analysis portfolio will likely underperform the market after accounting for trading costs and your time value. Malkiel also addresses mutual fund managers, professionals paid to do fundamental analysis full-time. If fundamental analysis worked reliably, these experts should consistently beat the market. They don't. Studies consistently show that 70-80% of actively managed funds underperform their benchmark indices over 10-year periods. The professionals with unlimited resources can't beat the market. Why would you expect to do better? He explains the few investors who do beat markets through fundamental analysis usually have edge, unique information, superior analytical ability, extraordinary discipline, or access regular investors lack. They're exceptional. Assuming you're exceptional is statistically unwise. Better to assume you're average and adopt strategies that work for average investors, which means index funds. The action step. If you're spending significant time analyzing individual stocks, calculate your actual returns, including all trading costs and time value. Compare to what you'd have earned buying index funds with zero analysis. Most people discover their intensive analysis generated worse returns than doing nothing. If that's your situation, stop analyzing and start indexing. Chapter 5. Why index funds beat almost everything. After destroying technical and fundamental analysis, Malkiel presents his solution. Broad-based index funds that own the entire market. This approach is simple, cheap, tax-efficient, and beats the vast majority of active investors over long periods. It's the closest thing to a free lunch in investing. An index fund owns all stocks in a market index, like the S&P 500, largest 500 U.S. companies, or total stock market funds, essentially every public company. When you buy an index fund, you own a tiny piece of thousands of companies. You're not betting on individual winners. You're betting on capitalism and economic growth continuing, which is a pretty good bet historically. The first advantage is cost. Index funds charge minimal fees, often 0.03% to 0.20% annually, because they don't pay analysts, don't trade frequently, and operate with minimal overhead. Active funds charge 1 to 2% annually for management. That usually underperforms. That 1 to 1.8% annual fee difference compounds into massive wealth differences over decades. Malkiel shows the math. $100,000 invested in an index fund charging 0.1% annually and earning 8% market returns grows to $1.44 million in 30 years. The same $100,000 in an active fund charging 1.5% annually and earning 7% after fees, assuming the fund matches market returns before fees, which most don't, grows to $761,000. Same starting amount, half the ending wealth, purely from fees. The second advantage is diversification. Index funds own everything, protecting you from individual company failures. Enron shareholders were wiped out. Index fund owners barely noticed because Enron was a tiny fraction of their holdings. When individual stocks crash, and many do, index fund investors are insulated. Your portfolio's success depends on overall market performance, not picking winners. The third advantage is tax efficiency. Index funds trade rarely, generating minimal capital gains distributions. Active funds trade constantly, generating capital gains you pay taxes on annually, even if you didn't sell shares. Over decades, this tax drag significantly reduces returns. Index funds allow your money to compound without annual tax friction. The fourth advantage is simplicity. You don't need to analyze companies, predict earnings, time markets, or follow financial news obsessively. Buy the index fund, hold it forever, ignore the noise. This simplicity removes emotion from investing. You're not tempted to sell during crashes or buy during bubbles because you're not making active decisions. You're just owning everything permanently. Malkiel addresses objections. But isn't indexing average? Don't I want above average returns? Yes, indexing gives you market returns, average by definition. But market returns beat the vast majority of active investors after fees. Being average sounds boring until you realize that average beats most alternatives. Plus, market returns of 8 to 10% annually compound into enormous wealth over decades. Another objection, what if I pick the right active fund? Some active funds beat the market, but identifying them in advance is nearly impossible. Past performance doesn't predict future performance. This year's top fund is usually not next year's top fund. Trying to pick winning active managers is another form of market timing that rarely works. Malkiel recommends specific implementation. For most investors, a total stock market index fund, owning all U.S. stocks, plus an international index fund, owning all non-U.S. stocks, provides complete diversification across thousands of global companies. Add a bond index fund for stability, if desired. That's it. 3 funds. Hold forever. Rebalance annually. This simple approach beats complex strategies. He also addresses target date funds, index funds that automatically shift from stocks to bonds as you age, becoming more conservative as retirement approaches. These are excellent for people who want even more simplicity. Pick the target date fund matching your planned retirement year, invest consistently, and literally never think about it again. The action step. Calculate your current investment fees. If you're paying more than 0.5% annually in expense ratios, you're likely in active funds that will underperform. Research low-cost index funds from Vanguard, Fidelity, or Schwab. Create a simple 3-fund portfolio. Total U.S. Stock Index, Total International Stock Index, and Total Bond Index. Transfer your investments. Then commit to never selling, regardless of market conditions. Chapter 6. Market timing is a loser's game. Malkiel tackles one of investing's most tempting but destructive behaviors. Market timing, attempting to buy before markets rise and sell before they fall. It seems logical. It feels smart. It doesn't work. Study after study shows that market timers underperform buy and hold investors, sometimes dramatically. The problem is, you need to be right twice, when to sell and when to buy back. Miss either timing, and you lose. Missing just the 10 best days in the market over a 20-year period cuts your returns by more than half. Those best days often happen during terrible markets, the recovery days after crashes when everyone's scared. Market timers frequently sell during crashes, locking in losses, and miss the best recovery days, missing gains. Malkiel shares devastating statistics. The average investor dramatically underperforms the market because they buy high and sell low, driven by emotion. When markets soar, they get excited and buy. When markets crash, they panic and sell. This emotional timing is exactly backward, but feels right in the moment. Studies show individual investor returns trail market returns by 3 to 4 percentage points annually purely from poor timing. He explains why market timing feels possible, but isn't. After major moves, explanations seem obvious. Of course, the market crashed, unemployment was rising, and earnings were declining. But before the crash, that same information was available, and experts disagreed about its implications. Hindsight creates illusion of predictability that didn't exist in real time. Professional market timers don't succeed either. Market timing newsletters, tactical allocation funds, and timing gurus have terrible long-term records. Some get a call right occasionally, becoming famous for that success. But their subsequent calls often fail. One correct call proves nothing. Luck guarantees someone will get it right. Consistent accuracy over decades is what matters, and nobody achieves it. The mathematics explain why market timing is so difficult. If you're out of the market during the 10 worst days over 30 years, your returns improve dramatically. But if you're also out during the 10 best days, returns crater. The best and worst days are unpredictable and often close together. The best days frequently follow the worst days during volatile periods. Trying to dodge the bad days guarantees missing good days. Malkiel also addresses dollar-cost averaging, investing fixed amounts regularly regardless of market levels. This is often promoted as safer than lump sum investing. His analysis shows that lump sum investing everything immediately, usually beats dollar cost averaging because markets tend to rise over time. Every day you're not invested is a day you miss gains. Dollar cost averaging is market timing in disguise, timing your investments based on comfort rather than maximizing returns. The psychological appeal of market timing is control. It feels better to do something when markets are scary than to simply hold and endure. But that action usually hurts more than helps. The best investment decision during crashes is doing nothing, staying invested, not looking at your account, trusting that markets recover as they always have. The action step: commit to never selling based on market predictions or fear. Never. If markets crash 30%, you hold. If experts predict crashes, you hold. If you're terrified, you hold. Your emotional reactions to markets are reliable, contrary indicators. You'll feel most fearful at bottoms, best time to buy, and most confident at tops, worst time to buy. Since you can't trust your emotions, remove them from decisions by never timing markets. Chapter 7. Asset allocation matters more than stock selection. Malkiel explains that your mix of stocks, bonds, and cash determines most of your returns, far more than which specific stocks or funds you choose. Studies show that asset allocation explains 90% of portfolio return variability. Choosing between a good fund and great fund in the same category matters little. Choosing your stock-to-bond ratio matters enormously. The principle is simple. Stocks provide higher long-term returns, but higher volatility. Bonds provide lower returns, but more stability. Young investors can handle volatility because they have decades for recovery, so they should own mostly stocks. Older investors nearing retirement can't afford major losses before needing the money, so they should own more bonds. Malkiel recommends the rule of thumb. Own bonds equal to your age. A 30-year-old should be 70% stocks, 30% bonds. A 60-year-old should be 40% stocks, 60% bonds. This automatically shifts from aggressive to conservative as retirement approaches. Some disagree with this specific formula, but the principle of age-based allocation is sound. He addresses the mistake of becoming too conservative too soon. Someone who shifts to majority bonds at 40 because they're getting older dramatically reduces long-term returns. At 40, you likely have 25-plus years before retirement and might live 50-plus more years. You need growth. Too much conservatism guarantees insufficient retirement savings. Conversely, the all-stock investor at 65 is taking unnecessary risk. A market crash right before or early in retirement can devastate finances. The sequence of returns matters in retirement. Losing 40% in year one of retirement is far more damaging than the same loss 10 years later. Some bond allocation provides stability when you can't afford recovery time. Malkiel also discusses international allocation. U.S. stocks alone leave you exposed to U.S.-specific risks. International diversification spreads risk across global economy. He recommends 20-40% international stocks for most investors. This percentage is debatable, but some international exposure is clearly valuable. The rebalancing principle is crucial. Over time, winning assets grow while losing assets shrink, skewing your allocation. Annually rebalancing back to target allocation forces selling winners and buying losers, a disciplined version of buying low and selling high. It also maintains your intended risk level. Without rebalancing, portfolios naturally become riskier as stocks outperform bonds. The action step: determine your target asset allocation based on age and risk tolerance. Write it down. Implement it through index funds. Set a calendar reminder to rebalance annually. This simple framework ensures your portfolio matches your situation and goals, adjusting automatically as you age. Chapter 8. The Winning Strategy. Simple, boring, and effective. Malkiel concludes with his complete recommended strategy, synthesizing everything into actionable advice. The strategy is almost offensively simple, which is precisely why it works. Complexity creates opportunities for errors and fees. Simplicity eliminates both. The core strategy. Buy low-cost index funds covering the total stock and bond markets. Hold them forever, regardless of market conditions. Rebalance annually, and never try to beat the market through stock picking, market timing, or active management. That's it. Everything else is noise. The specific implementation: choose your asset allocation based on age. Invest through 3 to 4 index funds. Total U.S. stock market, total international stock market, total U.S. bond market, and possibly a REIT index for real estate exposure. Automate monthly contributions. Rebalance to target allocation annually. Ignore financial news, market predictions, and hot tips. Malkiel emphasizes the psychological difficulty of this approach. It's boring. You're not doing anything. You're not outsmarting anyone. You're not getting rich quick. You're just consistently buying the market and waiting for compound growth to work over decades. This lack of excitement makes people abandon the strategy for something more thrilling, usually to their financial detriment. He addresses the question, so I should never try to beat the market? His answer is nuanced. For 99% of investors, yes, don't try. The odds are against you, the costs are high, and the time required is enormous. But if you genuinely enjoy investing as a hobby, allocate 5 to 10% of your portfolio to play with individual stocks. Use the remaining 95% for the boring index strategy that actually works. The tax optimization strategies matter too. Contribute to 401ks up to employer match for free money. Max out IRAs next for tax-advantaged growth. Use HSAs if available for a triple tax advantage. Only after maximizing tax-advantaged accounts should you invest in taxable accounts. This sequencing saves tens of thousands in taxes over careers. He discusses retirement withdrawal strategies. The 4% rule, withdrawing 4% of your portfolio annually in retirement. Adjusted for inflation, provides rough guidance for sustainable withdrawals. A $1 million portfolio supports roughly 40,000 annual withdrawals, with high probability of lasting 30-plus years. This helps determine retirement savings targets. Malkiel also addresses common life situations. For young investors, be maximally aggressive, nearly 100% stocks, because you have decades for recovery. For mid-career investors, maintain majority stocks, but begin diversifying. For retirees, shift to majority bonds for stability, but maintain stock exposure for growth. For heirs, likely return to aggressive allocation as their time horizon is long. The behavioral principles are crucial. Stay invested during crashes. Don't check your balance constantly. Ignore financial media predicting doom or boom. Trust that markets reward patience. Remember that feeling terrified during crashes means you're human, not that you should sell. The most important investment decision is doing nothing when every instinct screams to do something. The final message. This strategy won't make you rich quickly. It will make you wealthy slowly. Over 30-40 years of consistent investing in low-cost index funds, compound growth creates substantial wealth, typically enough for comfortable retirement and generational wealth transfer. The strategy works not through brilliance, but through mathematics, discipline, and time. The action step: implement this complete strategy within 30 days. Calculate target allocation, select specific index funds, set up automatic contributions, write down your commitment to never sell during crashes. Then, forget about your investments for a year. Check once annually to rebalance. This simplicity and discipline will outperform 90% of active investors while requiring 1% of the effort. There it is, 8 powerful lessons from Burton Malkiel's investing classic that's guided millions toward financial success. Stock prices follow a random walk and can't be reliably predicted. Neither firm foundation nor castle-in-the-air theories help you beat the market. Technical analysis is astrology for investors, sophisticated-sounding nonsense. Fundamental analysis doesn't work much better for most people. Low-cost index funds beat almost all alternatives over long periods. Market timing destroys returns more than it helps. Asset allocation matters far more than security selection. And the winning strategy is simple, boring, and effective. Buy index funds. Hold forever. Ignore noise. What makes a random walk down Wall Street revolutionary is its honesty. Malkiel doesn't sell false hope. He doesn't claim you can get rich quick. He doesn't pretend that complex strategies or expensive advisors provide value. He tells uncomfortable truths. Markets are mostly unpredictable. Professionals usually fail to beat them, and the simple approach beats sophisticated alternatives. The most important insight: for the vast majority of investors, trying to beat the market is a waste of time, money, and energy. The financial industry desperately wants you to believe you need their expertise, their research, their management. You don't. You need 3 index funds, automatic contributions, and patience. That's it. Everything else is complexity designed to justify fees. Your action plan: first, calculate all investing fees you currently pay. If you're in active funds charging over 0.5%, you're bleeding wealth. Second, research low-cost index fund options at Vanguard, Fidelity, or Schwab. Third, create a simple portfolio: total stock market index, international stock index, and bond index based on your age. Fourth, transfer existing investments to this portfolio. Fifth, set up automatic monthly contributions. Finally, commit to never selling during market crashes and never trying to time markets. Remember Malkiel's central message: investing doesn't require genius, sophistication, or complexity. It requires discipline, patience, and humility. The discipline to invest consistently, the patience to hold through crashes, the humility to accept that you can't beat the market, so you should join it through index funds. These 3 traits create wealth more reliably than any stock-picking genius. Thanks for watching this deep dive into one of investing's most important books. If these lessons convinced you to simplify your investing and stop wasting money on fees and failed strategies, hit that like button and subscribe for more content that cuts through financial industry BS. Comment with how much you're currently paying in investment fees. You might be shocked when you calculate it. And remember, the best investment strategy is the one you can stick with for decades. Complexity fails because people abandon it. Simplicity succeeds because it's sustainable. Buy the market, hold forever, and let compound growth make you wealthy. It's not exciting, it just works. Now go simplify your portfolio and start winning the investment game by not playing it. Your future wealthy self will thank you.